100 years ago, World War I ended. It was a horrific war. It was fought in Europe, mainly between Germany and France. And Germany invaded France through what was then later called the Maginot Line. Maginot is a French general's surname. And so what France did after World War I, they said, well, Germany's not going to attack us again the way they did before. So they started building up embattlements, weapon fortifications, concrete bunkers, so Germany could not invade France through the same way. But they did not move it all the way up. They did not continue building the Maginot Line up through Belgium because they did not want to offend the Belgians, and so they didn't. So fast forward to World War II, and Germany did not attack France crossing over the Maginot Line. They attacked France going through Belgium. The point is that France was fighting the last war. France was getting ready to fight World War I again, and Germany was looking forward to fighting World War II. Now, I bring this up because I often find that people are fighting the last war. Hey everybody, this is RC Peck, and this is my weekend podcast. And I think it's a good question to ask yourself, where is your Maginot Line? Where are you fighting the last war? So let's just presuppose you are fighting the last war, because certainly part of you is. Even if you're completely consciously competent, part of you wants to fight the last war. That is how our brains are designed. So I want to show you a handful of price charts where I believe a very important and powerful entity is fighting the last war and how it continues to fight the last war. And because it's consistent in fighting the last war, it continues to hurt a lot of people. And the entity I'm talking about is the Federal Reserve, the US Federal Reserve. Today it's Janet Yellen's Federal Reserve. And if you look at the screen here, you see two price charts. At the bottom, it is the federal funds rate. And at the top, on this at least price chart, is the US dollar. And those three vertical red bars are when Janet Yellen's Fed raised the federal funds rate. So the first one was back in December of 2015. Now, what I thought was interesting, when it raised it, the US dollar fell. Didn't go up, it fell. And then when Janet raised federal funds rate again in December of 2016, 1 year later, the dollar kind of went up but then came back down. And then she raised the federal funds rate again in March of 2017, and she just announced she's doing it again. But just notice that the US dollar, in response to the change in the short-term interest rates, is still trying to find out which direction to go. Should it go higher? Should it go lower? And basically what you're seeing for the last 2.5 years is the dollar doesn't know which way to move. I mean, it's kind of gone up, it's kind of gone down, but generally speaking, it's exactly where it was 2.5 years ago. So the dollar is attempting to digest and figure out which way to go, and it still doesn't know which way to go. It's okay to know that, we just know that it hasn't figured it out yet. Next, look at the yield on the 10-year Treasury. So again, on the bottom part of the chart is the federal funds rate. And then at the top is the yield of the 10-year Treasury. Now, what I find so interesting is the first time Janet Yellen raised interest rates, and it had been quite a while, notice what happened to the yield on the 10-year Treasury. It fell, and not just a little bit, right? It fell from about 2.3% all the way down to 1.3%, came back up. Yellen raised rates, short-term rates, one more time, and then one more time again, and started falling again. So this is interesting. As short-term rates are going higher, the rate on the 10-year is falling. And when you see the rate falling, that means the price is going higher, right? So as short-term rates are going higher, the price is going higher on what people are willing to pay for that 10-year bond. This is interesting. Now, let's go forward and look at the 30-year yield. So this is the yield on the 30-year bond in the US. And again, very similar to the 10-year yield. After Janet raised interest rates in December of 2015, the yield of the 30-year fell. Then she raised rates a year later. Nothing happened with the yield of the 30-year. Then she raised rates again, and then they started falling, and she raised rates again this week. So what you have is that the yield on the 10-year and the yield on the 30-year going down as short-term yields are going higher. Okay, so why does this matter, or should it even matter? Look at this price chart here. So this is a price chart of something called the yield curve. And there's a pretty bad correlation to what happens in the economy and the stock market when short-term yields get above long-term yields. Now, the black horizontal line that goes through two of those red circles is where short-term and long-term yields are the exact same. So as long as this line, the most squiggly line, stays above the zero, that means that long-term yields are higher than short-term yields. But if they get to that zero horizontal line, then we have a very, very high chance of going into a recession. Now, I put this dotted diagonal line going higher because when the yields went negative in 2006 and 2007, they did not go as negative as they did in 2000. And so it's very likely that we don't even have to go into a negative or an inverted yield curve in 2017 or 2018 to spark a recession. And the reason why this is important is because there's a very high correlation where when the US goes into a recession, the average stock market fall is 35%. Will it be more this time? Will it be less this time? I don't know. But I bring this up because many people who are fighting the last war are fighting it on something called valuations, looking at the valuations of stocks or the valuations of sectors. And when you do that, that may have worked in the 90s and the 80s and the 70s and the 60s and the 50s. But the leading indicatorness of it has pretty much gone away since Netscape IPO'd in 1996. And the point of me bringing this up to you is there are better ways of fighting the next war than what worked in the last war, just like France unfortunately found out that once they built the Maginot Line, basically told the Germans, so whatever you do, do not come across this way. Come up through Belgium and then attack us. And so the question is, what is your Maginot Line? What is the thing, what is the behavior you're using right now, right, to fight the last battle, to fight the last market correction? Because ultimately what you have to know is which way, again, staying with the metaphor, which way the Germans are going to attack this time. Which way are you going to notice that the market's going to correct 30, 40, 50%? It may not be as obvious as, or it may not be the same way as it was before. So here's the takeaway. First of all, guys, fight the current war. Use a strategy for the current war. And the question is, what is your Maginot Line? Because we all have one. How are you fooling yourself? Because we all fool ourselves. And I think part of the answer is to look at price growth. Look at the price of sectors and locations and indices. Look at the price of it first. Look at price charts. Now, there's many ways to look at price charts. So I understand there's a lot of nuance in the best way and what frequency and how long and the time frame. But again, the same word is as in the first one, price growth. This one's price charts. And then the last is price flow, right? I often talk about where money is flowing. And what is absolutely most important is where price is growing the most, both in absolute terms and in relative terms. And that's going to tell you where, again, I kind of hate the war approach, but I'm just sticking with the Maginot Line and Germany and France and Germans and French, and just saying, where is the next attack going to come from? Where's the next correction going to come from? It may not always come from where it came from before. And so ask yourself better questions. The better questions you can ask yourself, the better your money is going to be protected. And so think about, what is your Maginot Line? That's a powerful question because we all have it. And the one I, again, see most commonly used is valuation, right? Price to earnings ratios. Now, you can know what they are, but what's most important is that price flow and looking at price charts the right way and looking at price growth both in absolute terms and in relative terms. Thanks, guys. I hope you have a great weekend. It is Father's Day weekend here. I actually don't know if it's Father's Day all over the world or if it's just a US thing this weekend. But please have a great Father's Day weekend. And this is just another step in helping you protect your portfolio and your future. Until next time, this is R.C. Peck. I want to quick tell you a story about my dad. My dad is 77 this year. And one of my favorite memories, my dad is still alive, is when I was first living in San Francisco. And this was back in the late 1990s. And I was down in this part of San Francisco called the Marina. And even back then, 20 years ago, parking was very, very difficult. And it was a Friday night, and it was me with my parents, and we were going out to grab some dinner. And I was in a parking garage. And there were no spots. And there were no spots on the street. And it was, 7:30 on a Friday. And I saw someone. I motioned to them to see if they were going to leave. They were. I followed them to their parking spot. And I waited, and they got that I was going to get that. And as they pulled out, this little S4, an Audi A4 that's supercharged, slips in there. Slips into my spot. My spot. I get out of the car. I'm furious. I've been driving around for half an hour. I'm furious. I pop out of the car and I say to the guy, I've been waiting for that. That's my spot. And he looks at me with arrogance. He actually looked at my car, and he very quickly got that his car was much more expensive than my car. And with arrogance, he said, too bad. And for better or worse, I said, if you park there, you will not come back to the same car. Now, I said that out of anger. But here's the thing that I remember most about that. I didn't know it, but my dad was right next to me. He had popped out the other side of the car and stood right behind me, as in I've got your back. And my dad's 5'2", probably weighs 170 pounds, very athletic, very strong. And I've talked before in these podcasts how I think I'm flexible. And then I show it to my dad and he's like, oh, I can do that. And it was just, what a feeling of support and love to know that at that moment, my dad had my back and he was ready to back me up. Nothing ever came of it. He walked away. the Audi S4 guy walked away, and my dad and I looked at each other and said, let's go find another spot. But to know that your dad's got you, what a great feeling. And it's one of my favorite memories of him even still, because of that feeling, knowing that without asking and without even knowing, he was there. And so I hope you think of your favorite memory. We all have different types of dads. Mine was a workaholic. He was given up basically for adoption at 2. And so he did his best, as we all do. And just, thinking about what maybe your favorite memory of your dad is or was is something that I could share with you too. Thanks, guys, for being in my world, and I will speak to you soon.